Welcome to episode number 32, if I'm not mistaken, yes, of Daily Market Mastery with me, popular investor Christian Rauchenwald. As usual, in Daily Market Mastery, we are using Elliott Wave Principle or Elliott Wave Theory to try to predict market movements or future market movements in stocks and indices. To basically show you or give you some insight into why I'm entering certain positions and how I'm managing my portfolio. Now, if you are curious about my track record, you can follow the link that's shown here and also pinned in the chat and in the video description down below to actually check out my multi-year performance so far and how we're doing this year. If you want to learn more about Elliott Wave Theory, you can find a link in the description that allows you to read the book about it for free online or order a physical copy, and as well as all the other resources, so the software that I'm using and our one-page cheat sheet. And yeah, so that's pretty much it. Now, usually yesterday we had our Monday episode, and usually we are reviewing a new stock pretty much every day, but we now have so many things to keep an eye on that for today I actually, and especially we already went quite far ahead in terms of picking stocks that have future earnings. So today we're actually going to look at something that we reviewed in an earlier episode, to be precise, in episode number 16. I'm going to share my screen real quick with you guys. So if I drag over this window here, you can see in episode number 16, we looked at IEP, Icahn Enterprises, pretty much after or straight after Hindenburg Research published their article about them with the claims that the stock is overvalued. Back then, not sure if we have it labeled here. Probably we have. Yeah. So let's see how far we go, or picking the best moments. It looks like a lot of chaos on the chart, but pretty much the point, I mean, you can check out episode number 16 yourself. So I'm going to share the link to make it easier. Watch episode number 16 at the. So if you want to check it out, the conclusion ever was that if we look on the long-term chart, and there we use TradingView instead of Motive Wave because I didn't have the full data in Motive Wave because Interactive Broker didn't provide it. Now there's a workaround for that, so we're going to use that workaround to actually label in Motive Wave. But the idea was that we basically, since 1992 or something like that, have like wave 1, 2, 3, 4, and now wave 5. Finished in 2013, and since then we have been basically, which makes this entire thing here a wave 1, which means we're in wave 2 now, and in wave 2 we expect the 38.2 to 68.2. 68.2. Yeah, like I'm getting confused here. Let's throw Fibonacci on the chart real quick. 38.2 to 61.8. Yeah, obviously the exact opposite retracement. And if we were to have that retracement, or alternatively, we expect a drawdown into the area of wave 4 of the previous impulse wave of a lower degree. So if this here is wave 1, 2, then we would expect the previous impulse wave would be that of a lower degree. So the previous impulse wave would be that wave 1, and then a lower degree would be the 1, 2, 3, 4, 5, and so like into the area of wave 4, very often the bottom of wave 4, which also happens to align with Kennedy channeling technique, where we would expect, so we have our so-called base channel. I'm going to show you all the steps again, since we don't have the labeling in Motive Wave yet. So we have our base channel, acceleration channel, deceleration trend line, and then following our destination channel, which is that here and that here. And all of them worked out perfectly nicely. And so point being, with the Kennedy channeling technique, very often wave 2 will touch the top or the median of that base channel before we then have a wave 3. And we're actually gonna take a look at how this actually looks like and what happened since our episode that was pretty much a little bit more than a month ago. Now, back then in that episode, I actually also mentioned I would potentially short it right now, because I believe we will again see like the $20 mark, potentially the $10 mark, so the bottom of wave 4, so that potentially I would start buying around 25, if I recall it correctly, so a little bit above the base channel, and then as we go closer to that area here, increase my positions further. Now, unfortunately on eToro, I'm unable to short Icahn Enterprises, so couldn't enter that position, but still, let's take a look at how accurate that forecast has been. So if we look here, and by the way, just a quick reminder, we can see here at the time of the episode when we made it live, the price was still in the beginning of the episode. Do we have the beginning somewhere? IEP, that was review of other stuff, so probably then here. So in the beginning of the episode, it was around $43. And at the end of the episode, it was at $41. So that's where we were when we started that episode. And I'm going to close or actually move it away. Go in there. And then we go here in Motive Wave. Now, as we can see right now, as of yeah, we have a monthly chart right now, so there we don't see it very well. But if we take that last candle here, we have a high of 23 and a close of 22, whereas yesterday's low was actually at 18. So as I said, if we would have entered at 25, yeah, not sure if we already reached the bottom here, so that's a different question. But basically, potentially, based on the analysis made a month ago, we either would have shorted it down, which I couldn't do, or we are now in the area where we should enter or potentially will enter a trade. Now, to label this out, before we label it, actually, we have to jump into wrong chart. We have to jump into trading view, and here we need IEP, Icahn Enterprises. And why do we need that? So to just make sure that our data is indeed correct. So if we look at this low here, that's our wave 2, it says around 795. And if we take that low, that should be this one here, it is oops, wrong side, have to zoom the other direction. Like someday I will get used to that. So 693 in November 1, 1989. November 1, September, October, that's 13th November. Okay, I have to zoom in here as well. Oops, didn't want to move that. What do we have here? 597 on the 9th of November. Okay, let's make sure here we are currently on a monthly chart. So let's make sure that we here also jump on a monthly chart. That should make the whole thing easier. No, it screws with our entire, great, that the lines don't, oh no, that they still work. Okay, so here the low is 597 on the 2nd of November, and our low is 705. So our data here is still not correct. Like how much are we off here? What do we have here? Here our low is 1940, and here our low is the 1951. Yeah, that sucks when the data isn't fully accurate. What do we have here? Low 34, and that would be this one, low 34. So that one is correct. Then that spike down here, low 1004. And that spike we don't even have here, I guess. Yeah, so Google does not have that spike, which is interesting because 1940 was this one. So potentially that might be a fluke. So that might actually be a mistake in the data here. Yeah, which is relevant. Because it would move our 0.4 to be actually here. Yeah, and here-ish. And make that here 1, 2, 3, 4, 5, with 3 not being the shortest. Yeah, or 1, 2, 3, 4, 5. So either way. And changes our entry point a little bit, because that would mean that our entry point would actually be the one we would have then considered, the one at 1870, like so like the low that we had here at 1851, a definite entry point, which is a little bit of a like pity, because we actually could have entered already. And we likely then will not go further than here. Now let's still, I mean, there is some discrepancy with the data that we have, but basically overall, if we take this and use Kennedy channeling technique as promised, so again, the data here is a little different. So we might not get the exact same result, but just to show you Kennedy channeling technique again. No, don't need that. I want to just use that here. So first we would pick a low point like this one here. If we are looking at an upwards direction, if we would go down, we would look for a high point, yeah, and we pick that as our point 0. Now we should have a first wave, which would be, I don't know, 1, 2, 3, yeah, like it's on monthly, we might not be able to see it, but we're gonna assume, okay, that this here is 1, 2, 3, 4, 5, so that's basically our starting point, 0, 1, and then that correction here would be our point 2 potentially. And now if we do that and extend it and add a median, then that's our base channel. The moment we have a breakout from the channel would indicate that we're in wave 3. And so even if we do not have all those candles here yet, we just see, okay, we are back in, what is it, in 24 and 2004, yeah, and we see like, okay, the breakout here and short retesting, and then we go further. We know, okay, we're in the third wave now. So what we would do is we take, yeah, that's not perfectly on point 2, that should be point 2, and that should then be a little higher. So we take a new channel and put it on point 2, and basically, sorry, not point 2, we put it on point 1, and whatever high we have. So we would put it here with a parallel through point 2, yeah? And now what we're looking for is a breakout to the bottom. Now we see that, okay, we actually don't have a breakout to the bottom, we go higher. So as new candles form, we adjust this and make it higher, make sure to adjust the bottom to stay parallel to point 2, and still no breakout. And we keep repeating this. Obviously, we don't have a breakout to the bottom, so we eventually end up here. We obviously have to adjust, again, the bottom here and extend it. And eventually we don't have a new high, but we suddenly see, okay, we're going down and we have a breakout to the bottom, yeah? Which would indicate, okay, now we're in wave 4. And for wave 4, now the question would be, what's the high here? The high here is 127.39, and that here is 131. So actually that point is higher. So that's the point where we leave it, yeah? And again, adjust for point number 2. So again, that would be 1, 2, or 0, 1, 2, 3, and now we're in wave 4. And to determine the end of wave 4, we don't need a channel, we need a trend line. We put that trend line on the high point, and then basically we pick the next high or another high. So that could be either the next one that we extend here, but potentially also it could be like this. Yeah, it's a little, that part is a little tricky, because basically if we pick it like here, it's not wrong. But it's like taking some time for us, yeah, get us there to have the official confirmation. But that would be the easiest thing. So whatever next high point we have, again, we might not pick the immediate high point, but that would be a deceleration channel. And when we have a breakout to the top from here, we would have like kind of confirmation that we're in wave 5. Now, Kennedy channeling technique is not 100% accurate, but it's accurate enough to really use it reliably to get an idea of the wave count we're in, and then you can confirm the wave count to figure out if it's right or not. Yeah. So now with that, so we know, okay, based on Kennedy channeling technique, 0, 1, 2, 3, and we're now in wave 4 because we have the breakout to the bottom. Kennedy channeling technique suggests that very often wave 4 will touch the top or the median of the base channel, and we can see while it doesn't perfectly touch, it gets very close to it, which means very often, not always, we can actually have our pending buy orders in that area. Yeah? So we can have our pending buy orders here and say, okay, hey, we're actually going to start buying at this point. And wait, that high is 149. So 1, 2, 3, 4, yeah, 5. So we can buy at this point already as we approach the channel, and to the median we can increase the position. I mean, based on Kennedy channeling technique, if we then used actually the Elliott wave to confirm all of this, we can find additional criteria like, yeah, like Fibonacci retracements and whatnot, yeah, and Fibonacci relationships that will point us towards, okay, should we buy here or not, yeah? And yeah, so that we have our wave 4 bottom here, and then if we know, again, at this point, we definitely would, based on Kennedy channeling technique, know, okay, we're now in 5th wave territory. And for the 5th wave, we can then take the point of wave 4, which would be this one, our point 2, with a parallel through point 3, which is here, show the median and extend it. And the 5th wave will either reach the top or the median of that so-called destination channel. In this case, we reach the top. Not the top, the median, but not the top, and we take it from there. Now, if we look at not semi-log scale, but arithmetic scale, it might even become more obvious. Now, it's like a little bit harder to see here. We would have to redraw the channels because obviously they are now distorted. But yeah, so semi-log scale it is here, which gives us a profit target here, which says, okay, hey, from here to here, not sure if the auto labeling will get it right. Yes, it will. It looks like this. Yeah. So auto labeling says 1, 2, 3, 4, 5. Okay, the 0.4 would be different. Is that one actually lower? So maybe that one's lower. So that one has a lower at 1984, and that one has a lower at 1940, 1984. So more likely this. Could also be this, so, but yeah, so, and here we would have to figure out the corrective pattern. Now, what else do we have here? So in terms of, yeah, we have to consider rules of alternation. So this corrective pattern looks ABC something, ABC something, so that might be a combination of a corrective pattern, where that here is a very, yeah, like, quick, in quotes, in relationship corrective pattern, which gives us now, okay, that this is here is wave 1, and we're now looking for where does wave 2 go. So for that, we can get rid of pretty much all the channels here, because they were only used to label at 1, 2, 3, 4, 5. And now the important thing that we have in terms of where does wave 2 go, we can add a horizontal line to the point of wave 4, because again, this here is now 1 and 2 in progress, and wave 2 will very often retrace into the area of wave 4, and very often at the end of wave 4 of the previous impulse wave, 1, 2, 3, 4, 5, of a lower degree, which means that would be the point that we're aiming for. Additionally to that, I didn't check it before, but let's put a Fibonacci retracement there. Very often the Fibonacci retracement will be in the 38.2 to 61.8 area, and we can see how that here perfectly aligns, yeah, which would indicate that indeed this here now was wave 1, and we are now basically wave 2, and we're now basically in the progress for wave 3. Yeah. Now for wave 3, we could then again put a base channel here, extend it, and we would basically, once we have a breakout from here, we would have confirmation, which means that we actually over time, again, we're looking at you can see how many years we're looking here for like things, so that the relationship still fits. So we started from like 92 till 2014, so that's 22 years for the first wave, and then from 214-ish to 23, so 9 years for the second wave. Yeah, so we're talking again about a multi-year progress to get out of there. Now for that, additionally, we would have to confirm the corrective pattern here. If you've watched previous episodes, you know that when it comes to corrective pattern, I'm not like yeah, I wouldn't say like not genius, but that's an area where I'm still constantly learning, because they just are so complex. There are just so many more variations. Not sure if my desk cam is working, but let's try. Yes, it's working. So just as a reminder, in terms of impulsive patterns, we have a regular impulse, a leading diagonal, and ending diagonal, which are 3 different variations. That's all there is. And overall, we are always looking on the biggest degree for a regular impulse that then in wave 1 might consist, instead of a regular impulse, of a leading diagonal, and wave 5 might be, instead of a regular impulse, an ending diagonal. But overall, we're always looking for this. Whereas with corrective patterns, we have zigzags, we have flats, we have then combinations that are double zigzags, double threes, triple zigzags, triple threes, and then triangles on top of that. And especially when we talk about triple threes, you can see a triple three consists of any corrective pattern, not a triangle, not a double dx, double dx can interchange with, what's dx, not a double zigzag, not a triple zigzag, and that one can be any corrective pattern. So there you can have a whole selection of corrective patterns that make up one wave 2 or one wave 4, which makes it harder to label out the corrective patterns. To give you an example, I think in the, not here, yeah, there it's going to eventually complain. Yeah, there our data now is lost. Great. So here, for example, if we look in the NDX, we can see we have 1, 2, 3, 4, 5. Get rid of the volume for like wave 1, and then we have a combinative corrective pattern that actually consists as ABC, then wave X, which also divides into ABC, and then ABC again. Yeah, so definitely not too easy. Now, if we circle back here, however, we have 2 points that tell us, hey, we actually hit the low here, yeah, which means we can actually open a position in IEP now. Again, while with the original data, I would have assumed that we might go lower, but we fulfill already 2 criteria of the Elliott Wave Theory. First, if we have the base channel, I'm going to put it back here for the first original impulse wave that already finished. Then we can see we clearly touch the median of that base channel even. Yeah. Second, we are exactly in the 61.8 retracement area where we had a bounce off. Yeah. And third, it's the wave 0.4. So while we unfortunately missed the entry, so we should have actually probably entered that sooner, we actually should do that then later when I can actually enter proper stop loss. It's a little bit unfortunate an eToro that IEP with stop loss at what do we have here? 18.03. Yeah, so 18.03 and take profit. Would be at above. So if we talk about profit targets here, and again, we're talking multi-year, we're not talking in a week, in a month or something, yeah, then we would get a Fibonacci extension, throw it here, and then our first profit target would be the 138.2. So we talk about like at 513.21. So we obviously get an insane risk-reward ratio here. Where if we are wrong, if somehow this is not the finished wave 2, but based on this data, it actually should be, especially because then potentially, like this could either look like A, B, C. So if we consider if that's a zigzag, then it needs to subdivide into an impulse, another zigzag, and an impulse, yeah. And in an impulse, if we look here, that could be 1, 2, 3, 4, 5, would make this an impulse. It could also be 1, 2, 3, 4, 5, where there wave 5 falls a little bit short, then wave A would just become here. And then A, B, C, not looking nice. Again, we would have to look closer and to then work things out. But potentially that could also be A, B, C as like this. And then here we would have either 1, 2, 3, 4, 5. Although that would then be an ending diagonal, and which it can be in a flat corrective and in a zigzag, so that would also check out. And if we then, again, we would need to look on lower time frames to confirm that, but on first glance that works out. And then if we take a trend line, very often wave A and wave C in a zigzag will be identical. And while it's not perfect, I mean, not in terms of how they look, but in terms of movement, yeah. And while it's not perfect, but it's close enough. So it's a pity that we missed that, to be honest, like, because let's switch to daily or 2 days. It's where we usually go. So here we go. And yeah, like there, yeah, like basically we just May 4th. So that's where the whole thing started, and there we go down. Yeah, so basically we'll just have to wait. Yeah, like, but overall it's a pity that we couldn't short it, because that would have been an in quotes or not easy, but reasonably easy 50% profit on the position. So if we risk 2%, it would be a 1% gain for the portfolio. And yeah. And then now from here, we're going to enter that position, or I'm going to enter that position in the portfolio later today with like around 2% of the portfolio. And again, risk reward ratio is going to be great, because we have down to 18, 10% would be 2%. So like we have 20% risk with on the 1% that we invest. So we have 0.2% overall risk with 1,000% or 2,000% upside. So over multiple years. Again, then only on the 1% that we invested. So still over the years, if we turn out to be right, we should walk away with a decent profit. And if we turn out to be wrong, it's only a 0.2% risk for the portfolio. With also giving us the option, if we see that 1, 2, 3, 4, 5, so the impulse wave that we need here starts to develop, then we can obviously at some point either take profit. So if we have wave 1 finished, we can take profit and then wait for wave 2 and re-enter. Or we can also, once wave 1 finished, just keep the position open. So to hold it longer than a year, which in return then should give us some, depending on the country in, might be a tax advantage for long-term holdings over short-term holdings. And then with wave 2, we could then basically increase our position and keep doing that. So then wave 3, wait, wave 4, increase the position, wave 5, then potentially close it. Or if it's still not the entire wave 3, wave 2, increase position and so on. So yeah, but yeah, that's then pretty much it for today. So I feel like today's episode served multiple reasons. First of all, it provided one example where something that I covered in the stream less than a month ago actually applied. So again, I mean, to be fair, like applied 75% because we had a little bit wrong data here. So with that data point, assuming that we might potentially go down further, when in fact that would be the level that we were aiming for. But other than that, Kennedy channeling technique applied. So in our, as we can see here in the past, where we had the base channel, and again, I'm going to put that back real quick just for a second. So 0, 0, 2 and parallel to 1. So we have the, oops, wrong button. We have the base channel that barely gets hit here at the top, according to Kennedy channeling technique in wave 4. And yeah, we have the retracement into the area of wave 4 and so on. So yeah, I feel like this serves as a reasonable good example to show that when done right, Elliott Wave Theory can be a powerful tool to not only tell you, sorry for the noise, my wheel from the chair got stuck somewhere. So that not only to tell you when markets will turn around or where they will turn around, but also to give you a target area of where it will happen. Now, potentially, obviously, IEP can move lower, but if we consider that we've already touched that area, that it's the 61.8 retracement, so we already touched the area of wave 4 of the previous impulse wave of a lower degree. It's the 61.8 retracement. We already can reasonably on first glance label this as an ABC corrective pattern. Could also be a combinative corrective pattern where this here is some ABC and that's then a wave X and then this is an ABC. But overall, yeah, it looks reasonably well enough, especially for the time effort put in, and it gives us a great risk reward ratio. Now, does that mean that Icahn Enterprises is not undervalued or overvalued? Well, technically, if we look at the numbers from Hindenburg Research, it is still overvalued and should go down to around 10 or so. Yeah, which is also, I think, in episode number whatever it was where we looked at it. So in episode number 16, I think I also mentioned that so that the $10 that we get as a price target based on this data fluke here. I'm actually gonna triple check that real quick. So Yahoo Finance IEP chart, yeah. So drag that over here, and let's say max history. Can I get this as a line chart somehow? So here the low would be what, 20-ish, yeah. So so basically, while TradingView shows us a lower low, Google and Yahoo Finance both say, hey, that's where we've been, around 20-ish, yeah, or 18 point something. So we're gonna consider this down here a fluke, and actually our point would need to be there, yeah. And in that case, as said, we would have an entry now. Obviously, don't just buy that stuff because I'm saying it or so, because obviously everything that I share in this live stream really just reflects my opinion and why I'm managing the portfolio the way I do, and it's not like professional or financial advice, but you should always do your own research. Ideally, grab a copy of Elliott Wave Theory, do your own labeling, and work it out for yourself, and then make your own decisions based on your own judgment. I'm just sharing how I see it. If you disagree with that, feel free to share it in the comments down below. And yeah, so taking us back to the question real quick, if Icahn Enterprises is then not overvalued, I mean, if Hindenburg Research is right, then based on the reporting, they are right. It is overvalued, but if there's one thing I've learned is that the price of a company very, very often does not reflect their actual value, but it's just it's the whole thing that makes up Elliott Wave Theory, to be honest. It's like the opinion of the masses. If there are enough people that believe IEP is worth what it is right now, then they will jump into it and buy it up because it's cheap. Yeah, one could even argue that because for IEP, I think 85% of all shares for IEP are owned by Carl Icahn and his son, that there is a relative certainty because there are only then 15% of shares that can be traded. While this should create more volatility, it also makes it easier unless Carl Icahn would be forced to sell some of his shares, which I doubt he would do because he apparently is anyway, rather than using them as securities for loans. So if he needs money, instead of selling his shares, he just gets a loan and uses the shares as security, which means the shares don't get sold, which means there is a chance or it's easier to, in quotes, drive up the price. Now, I don't know how many shares are circulating. It's for Elliott Wave Theory, it's also not relevant, to be honest. But yeah, like an argument can be made that even if they are overvalued, maybe they have a good play. So I don't know, like maybe there are some things that we don't know that actually will justify an increase in value. Maybe it will just be human sentiment. Sorry, pretty short night. Maybe it will just be some mass psychology that drives up the value, or maybe it turns out that I'm wrong and that we will hit our stop loss here. Yeah, even if I'm wrong, however, we'll have to consider that my initial analysis from 4 weeks ago was actually correct in predicting that we will see a drop further. While I pointed out that we might see $10 because of the data fluke that we had in TradingView, I also pointed out in that episode that because it's the area of wave 4, now with the correct or better data, we see that the area of wave 4 actually is around 20, and we reached the 20, and it's the 61.8 retracement, and it happens to be the no, it was not. Yeah, that here was the top of the base channel. Never mind. Yeah. So overall, we have at least two rules / guidelines that point us towards, okay, this is going to be the area where we turn around for wave 3. So we'll wait and see what happens. I'm going to, in the afternoon, open the position once the markets are open to actually invest 1% of the portfolio into Icahn enterprises, and then we'll see if it turns out to be right or not. Anyway, with that, we're already a little bit over time, so I hope you were able to take something away from the stream. And don't forget, you can always check out my portfolio, and if you don't want to bother with analysis yourself, you can just copy my portfolio or any of the available other popular investors that might fit your investment horizon and risk appetite better. So yeah, thanks for tuning in. Have a great day. See you tomorrow with another episode. Till then.